On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Right, morning everybody. A bit of housekeeping before we kick off, and I'll say this now just in case you don't make it all the way to the end. It's school holidays at the moment, which means I'm going to take a week or so off. And that means I won't be here for the next 2 weekends, which means you won't get an episode of this podcast next weekend about the week ahead or the following week about the week ahead. So you're on your own for the next 2 weekends, and then we will return the following week. All right, let's look back at last week. A bit of a difficult one for share markets around the world. The US was down 2.9%. That's the third consecutive down week, the worst week since March. Europe was down 1.9%. The FTSE 100 in the UK slipped almost 0.5%, and the Aussie market was down 2.9% as well. Our little old market here in New Zealand, the NZX 50, did manage to eke out a 0.2% gain, which isn't much, but I think you probably take that against the backdrop of more rocky markets overseas. Rising interest rates have been the key culprit, and we'll talk about that in more detail shortly. Obviously, higher interest rates are a headwind for asset prices across the board. So whether it's fixed income, whether it's government bonds, whether it's shares, higher interest rates do tend to make for a more difficult environment for all of those assets. But in addition, I guess you've also had talk of a government shutdown in the US. There's only a week to go before the end of the fiscal year in Washington. That's on the 1st of October. So unless the policymakers can reach a deal by the end of Saturday, September 30, you might see a shutdown for some parts of the government that will create disruption. So that's weighing on investors' thinking. You've also got the workers' strike across some of the big Detroit car makers. That is also keeping people a little bit nervous. Plus, you've had that stronger US dollar as well. And I guess we should also note that September is traditionally a pretty tough for US share markets. We've talked about this a little bit in the past, and when you look at the seasonality going back over the last 70 or 80 years, September does come up as the worst month on average in terms of returns from US shares. And it's also the month that has the worst track record in terms of being up or down. So in some ways, it's not a huge surprise that we have seen that August volatility continue through into September. Rising interest rates, this has been the real story of the last couple of weeks. And last week, we saw the US 10-year Treasury yield rise further. It rose over 4.5% at one point during the week for the first time since 2007. So you've seen some fairly big moves in interest rates. And I think there's a couple of reasons for that. One is expectations of higher for longer central bank policy rates. So we had 4 major central bank meetings last week in the US, in England, in Japan, and in Switzerland. And even though none of those central banks increased interest rates, there was talk from some of them, most notably the Federal Reserve in the US, about rates needing to stay higher for longer. So that is something that's been weighing on investors' minds. And we've also had some better economic data too, such as US weekly jobless claims, which came in at the lowest levels since January. So that also caused investors to think, well, hey, maybe interest rates might have to stay higher for longer. Maybe the economy is in better shape than people thought, which means that rates will have to remain in restrictive territory for a longer period. So that was the key moves that we saw internationally. It was a similar story here in New Zealand, and we do tend to follow what happens elsewhere. So when you've got those interest rates going up in other parts of the world, we tend to follow suit. Our 5-year swap rate, which is a wholesale interest rate, rose as high as 5.22% last week, which is actually the highest we've seen since the middle of 2010. It got almost to those levels in last October, and then it sort of came down a bit, and it's been in a bit of a range for most of this year. But in the last 4 to 6 weeks, it has pushed higher. And last week, it sort of pushed through those October 2022 highs. So now we're back at the highest levels since June 2010, and that has been a headwind for fixed income as well. New Zealand fixed income has still had a fairly good year. The NZX investment grade corporate bond index up about 2.5% year to date, maybe a little bit more than that, which is not a bad return actually. That's certainly better than what we've seen from some share markets in the world and our own share market here in New Zealand. But things have come under a little bit of pressure just lately, and I guess I feel obliged to say that there is another side to that coin, because we often talk about higher interest rates in a negative sense, because that can mean that asset prices come under pressure. And it reminds us that borrowers and corporates that are holding high levels of debt have to face those higher costs. But important to point out that higher interest rates are actually a good thing for conservative investors. And I know there's a lot of people out there that are conservative savers that are looking for that regular, predictable, reliable income. And for them, with interest rates where they are, there are many, many more opportunities out there to find good value and get attractive levels of income. So it's certainly not all bad. There's absolutely a silver lining if you're in the camp of being able to take advantage of those higher interest rates from an investment perspective. Right, so that was markets. Let's run through some of the key releases last week, and it was central banks that were in focus. So we had the Federal Reserve in the US. They left interest rates unchanged, which was largely expected. So the Fed funds rate is sitting at 5.5%. That's the highest since 2001. People didn't expect them to move at last week's meeting, but it was all about the commentary and the forecasts about what they might do next. And in that sense, they are still saying they might need to hike one more time. I don't know if that's true. For me, I've got a feeling that this might be it. I could see them actually being at the top already, but we'll see. They're still talking about one hike, so time will tell. Looking ahead into 2024, they did adjust their projections a little bit to suggest that they won't reduce interest rates as much as they were previously guiding to. So before, they, I think, had 4 rate cuts penciled in for next year. So that's 4 25 basis point rate cuts. Now they've only got 2 penciled in. So they're basically saying things are stronger than we thought. We might need to leave interest rates in restrictive territory for longer. It might take a little bit longer to get inflation under control. So it's that higher for longer theme that we heard from the Fed. We also had the Bank of England, and they did surprise us. They surprised us with a pause. Most of us were expecting the BOE to hike rates again last week. Their policy rate is 5.25. We all thought it would go up to 5.5, and they chose to pause, which is actually the first pause we've seen since December 2021. And that was the point where they started removing all of that stimulus from the COVID era. And since then, they've increased their policy rate at 14 consecutive meetings. So every meeting, there's been a hike of some magnitude. And there's the first one since late 2021 where they've done nothing. So that's really interesting. They might still do more in the future. The market still sees the potential for one more hike, but for now, they're on hold. And I think one reason for that is the day before their meeting, we got some new inflation figures. We got the CPI report for August, and it was a little bit softer than expected. The market was expecting that to come in at 7%. It came in at 6.7. So that's the lowest we've seen in 18 months. So Still far too high, but at least they're making a bit more progress than people were expecting them to have made. The Bank of Japan rounded out the central bank trifecta on Friday afternoon in New Zealand, and New Zealand time, that is, Friday afternoon, and they didn't make any changes either. There was a bit of talk that you could see changes to their yield curve control settings, which is their policy that really sort of tries to keep government bond yields at a particular level and within a particular range. They didn't change that. They didn't expand it or move the cap higher. And they also left short-term interest rates unchanged, still slightly in negative territory. But there is still a feeling that they might at some point have to start thinking about how they withdraw all of that stimulus. They're sort of the last man standing in a way. Many of the other central banks around the world, whether it's New Zealand or Australia, the US, the UK, Europe, we've seen interest rates rise quite substantially, and many of those are now at a point where they've probably finished hiking interest rates, or they're close to finished. But Japan still has a lot of work to do, and with inflation now above their targets and at levels that we haven't seen in quite a while, core inflation is actually at the highest levels since 1981 in Japan. And the headline inflation has been ahead of forecast too. And for the last year and a half, it's been above their 2% target after being below it for a very long time. So things have changed in Japan, and it does feel like it is inevitable that at some point they will have to think about what they do about that yield curve control, whether they end it, and whether that is a precursor to abandoning those negative interest rate settings. But for now, no change. So that was central banks. Really interesting. A whole range of pauses, and we saw one in Switzerland as well, but higher for longer being the key message that markets latched onto. We had the September Purchasing Managers Indices, which are activity indicators for the major economies, and the trend continued of softer economic activity and a bit of margin pressure potentially creeping in, I should say. The US and Japan saw momentum slow. Their PMIs stayed above the break-even 50 level, while in the UK and Europe, they remained in contraction. So it was sort of a mixed bag, but generally things are looking reasonably subdued. Input costs kept rising, but what was really interesting is that firms are saying that it's getting more and more difficult to pass those costs on to customers. And I think that's something we've got to keep a close eye on, because if that's the case, while it's good for consumers and it's good for inflation that you're not seeing those consumer prices rise, it means firms to some degree are needing to absorb some of those cost increases, which means you might be seeing margins get crimped a little bit, which means profitability, dividends, and share prices will presumably react potentially. Dairy prices on the local front, this was a key release here, and we got some more good news. We had another increase from the Global Dairy Trade Index, the headline index up 4.6%, the second consecutive rise, the biggest increase in a year. Prices are still down quite sharply. They're down almost 14% year to date, and they're about 40% below where they got to in March last year, which was admittedly a 15-year high. But they're still down quite substantially from where they've been in recent years. However, that slump looks to have stopped. We've seen prices stop falling. So with a bit of luck, that means we're in a more stable place, and we'll watch with interest to see if prices can rebound any further. And in addition, in New Zealand, we had the GDP figures, and these were for the June quarter, so it's starting to get a little bit out of date, but still got a lot of attention. Growth was much better than expected at 0.9% for the quarter. The market was looking for 0.4. The Reserve Bank was looking for 0.5. So at 0.9, well above everybody's forecasts. Services industries were quite strong. They make up about 2/3 of the economy these days, and they grew 1%. Manufacturing activity also increased after 5 consecutive quarters of decline. So that was good. and primary industries slipped slightly. That's partly due to adverse weather effects. So all in all, it was pretty solid. I guess something else that was notable was the fact that there were upward revisions to previous quarters. So December 2022 was revised up from being down 0.7% to being down just 0.5%, and the March quarter was revised up from minus 0.1% to flat. So for those people out there who thought we were in recession, and I never bought into that, because I think recessions need to see a lot more weakness than that. They need to see rises in unemployment. It needs to be a bit more widespread than just a couple of negative numbers. But for those people who did buy into that rhetoric, it now looks as though we didn't get those two negative quarters. So that's good news as well. I think something that's really important to note is that while these figures were stronger, it's talking about what was happening back in the economy in April, May, June, which is quite a while ago. We're at the end of September now, and what was happening in April, May is not hugely relevant. So good to see the GDP stronger than expected, but don't necessarily read anything into that for what's happening in the here and now, because a bit of time has passed, and with China slowing down, with dairy prices and the Fonterra payout moving the way that they have, I think there are other things at play that weren't happening back then. But nevertheless, always good to see. Looking ahead, after all of those central bank decisions last week, inflation will be back in the spotlight globally. And the key release there will be the PCE inflation report in the US, which stands for Personal Consumption Expenditures. And this, I think, is out on Friday in the US, so we'll get it on Saturday. But my sense is that it will look very similar to what we've seen with the regular consumer price index in the US for the same period. And that would be a case of the headline inflation figures actually rising a little bit because you've had a rebound in fuel prices and so forth. So I think they'll probably keep ticking up. But the core inflation figures continuing to decline. So it'll be a bit of a mixed bag. There'll probably be something for everyone. Markets are expecting headline PCE inflation to increase to 3.5%, which will be up from the June lows of 3.0, still well down on the 2022 peak of 7.0%. But the core PCE is expected to keep coming down. So it's expected to slow to 3.9% in terms of the annual change, down from 4.2 in July, lowest since September 2021. Still not where the Fed wants it to be. The Fed is hoping it'll come down to 3.7 at the end of this year, 2.6 at the end of next year. So it's on that path, but still some work to do. But that will be something that gets a lot of focus, I suspect, next week. Remember that the PCE inflation report, that is the Fed's preferred inflation measure. So they watch the PCE, the core PCE, more so than some of the other inflation releases. So it is one that we need to keep a close eye on. We'll also get some flash CPI figures out of Europe. Flash means it's sort of the early release. They haven't got all the data, but they've got most of it, so it's a good early indicator. We'll get that out of Europe, and we'll get the Tokyo CPI out of Japan. All of these places are in focus at the moment in terms of growth, inflation, and what it means for central banks. China, there'll be more on China. We'll get the Chinese PMIs on Friday afternoon, and then there's another batch that will follow on Saturday afternoon. So we'll be watching those. China's obviously had a very difficult year, but in the last month or two, we have seen some of the data improve. We've seen last month's corresponding PMIs looked better. We also saw things like industrial production, retail sales, fixed asset investment stabilize, and it does appear that all of those measures we've seen from policymakers to support the property sector, support the economy, they're starting to work. China's not out of the woods, and it's still got a lot of challenges, but things have at least stopped deteriorating. So we'll be watching these figures on Friday afternoon, Saturday afternoon to gather more evidence about whether that is still the case. On the local front, the key release will be the ANZ Business Outlook survey for September. And this will be really interesting. I really enjoy this survey and I get a lot out of it. It's a very good leading indicator for what's happening here on the ground in New Zealand. I'll be hoping that we see another rise in sentiment and more progress on the inflation front. We have seen confidence rebound in recent months. So, headline confidence is actually sitting at the highest levels in more than 2 years. And the own activity measure, which is a really good, useful leading indicator for activity and growth, that's sitting at the highest levels since December 2021. So both of those things are now above their 5-year average, both suggesting that firms are in better spirits and companies and local businesses do seem to be taking a bit more of a glass half full viewpoint and seeing light at the end of the tunnel. Not across the board. Agriculture is obviously in a very difficult spot, and that came through in last month's survey. Agriculture was extremely downbeat. Prices, expected profitability fell sharply. But in contrast, you've got sectors like construction, which have become a lot more optimistic now that the housing market has stopped falling and started pushing up again. So we'll be watching all of those things as well as inflation indicators. There's a part of the survey which measures firms' pricing intentions, which is essentially the proportion of companies that intend to raise their prices over the next 3 months, I think it is, and that tends to be a very good leading indicator for where inflation is going. And obviously, of late, it has been coming down as inflation has, and at the moment, it's still sitting at quite high levels, but it's the lowest we've seen since early 2021, I think, well down from the highs, and hopefully it will continue to decline. Something else out of the survey that I think will be really interesting will be some of those labour market indicators. Because we've still got quite low unemployment, very low unemployment, I should say, still got a tight labour market. But we are starting to see signs of that easing, and we are starting to see signs of wage pressures just come off a little bit, which is good from the perspective of it feeding through to more subdued price pressures out there more broadly, because we need to see that happen for the Reserve Bank to get comfort that they've got inflation under control. So while it's been great to see some parts of society get some good wage rises, that has fueled inflation, and that has been part of the reason we've seen interest rates go up as much as they have. So it's a bit of a double-edged sword. We can't have our cake and eat it too. So that's something we'll be watching as well. On the corporate front, there are a few things to keep an eye on. Internationally, 2 results sort of stuck out for me on the calendar: Costco and Nike, one on Tuesday, one on Thursday in the US. And I think the retail sector, the consumer sector, is definitely worth watching as we sort of get closer to that holiday period where the consumer becomes much more relevant, and also because we're starting to see those excess savings from the pandemic in the US starting to be run down. And a lot of economists out there think that by the end of the year, they might have been expired. So are consumers on borrowed time? Don't know, hard to say, but we'll be watching some of these results to sort of hear what they've got to say and hear what they're seeing in their businesses. So Costco and Nike will be interesting as well. There's a few bits and pieces on the local front. I know the warehouse has got a result on Thursday, so we'll get our own read on the retail sector and hear about how they are seeing things from the coalface, and a few AGMs as well. Air New Zealand, Vector and Steel and Tube. Plus politics will remain in the spotlight. We've only got, it's less than 3 weeks to go now, isn't it, with the election, I think 2 weeks from this Saturday. So not far away, and we will have another leaders debate this week. News Hub will get their chance to host Mr. Hipkins and Mr. Luxon on Wednesday night. I'm hoping it'll be a bit more exciting than the last one, which wasn't hugely eventful. So we'll see how we go. There is a multi-party debate, I think, scheduled for next week on TVNZ next Thursday, if I'm not mistaken. And those multi-party debates tend to be a bit more fiery, don't they? With lots more viewpoints out there. So we'll be watching for that one too. But for now, we'll leave it there. That's all, everybody. Again, I'll have 2 weeks where I won't be recording week ahead episodes. So not next week, not the following week, and then I'll return. I might record a couple of other episodes on standalone topics. So you might still see a couple come through over the next fortnight. But other than that, you will hear a little bit less from me. But your support is appreciated. Thank you for listening as always, and we'll talk again soon. There's a lot of doom and gloom out there at the moment, but is that fair, or are there actually a few bright spots that we should be focusing on too? Have a listen here to find out.
For more insights, visit craigsip.com.